I'll be starting with chapter 2, which is tangible non-current assets. So this is the basic overview of the chapter. Tangible non-current assets, it includes IAS 16, and IAS 16 includes depreciation, revaluation, borrowing costs, and government grants. So all of these are covered under tangible non-current assets. Now, first to start with the basics, IAS 16 property, plant, and equipment. Now, the definition says that property, plant, and equipment are tangible assets held by an entity for more than one accounting period. It is held for more than one accounting period in production or supply of goods and services for rental or for administrative purposes. Now, what does this mean? So, property, plant, and equipment, these are tangible assets, which basically means that these can be touched or seen. Now, assets like goodwill, patent, these are intangible assets, and there's a separate standard for it. In this IAS 16, we're talking about tangible assets. Now, any asset to be classified as property, plant, and equipment, there are three criteria. First, tangible asset. Second, it should be held for more than one accounting period. That is, it should be non-current. And third, it should be used for business purposes. Now, that can either be for production of goods and services, for rental, or for administrative purposes. So, these are the three criteria: tangible, non-current, and for business use. Now, how to recognize or how to record the asset in the books? An item of property, plant, and equipment should be recognized as an asset when there are two criteria. First, it is probable that future economic benefits associated with the asset will flow to the entity, and the cost of the asset can be measured reliably. Now, what does this mean? Now, cost of the asset can be measured reliably. It's pretty self-explanatory that whatever you should be able to assign a value to that asset. The cost, you should be able to quantify the cost so that a value can be assigned for it. And so you should be able to basically reliably be able to have a value for that asset. And the other one says that it is probable that future economic benefits associated with the asset will flow to the entity. Now, what does future economic benefits mean? It means that there should be some gain out of the asset. You should be able to gain something from the asset. Now, that can be, for example, a machinery has been used to produce products. Those products will be sold and revenue would be generated. Now, the machinery is being used to generate the revenue. You're getting some sort of economic benefit by using the machinery. So, in that case, it qualifies the first criteria and it is fit to be recognized as an asset under IAS 16. So, these are the two criteria. So, overall, IAS 16 property, plant, and equipment includes tangible, non-current assets held for business use, and these can be recognized when the cost can be measured reliably and it is probable that certain future economic benefit would be received from the asset. Now, how to record the asset? Initial measurement. That is the first time when you're recording the asset in the books. What all components should be included in the cost of the asset? An item of property, plant, and equipment should initially be measured at its cost, as we studied here, that the cost should be measured reliably. So, the cost includes all costs involved in bringing the asset into working condition. Now, when you purchase the asset, it won't be immediately be ready for use. You might have to do certain, you might have to incur certain costs to make it available for use or to make it ready for use in the working condition. Now, all those costs incurred will be included. Second, initial capital costs such as cost of site preparation, delivery cost, installation cost, and borrowing costs. Now, initial capital cost, site preparation. Now, for example, you have purchased the asset and you have purchased certain machinery and you plan to install it in your factory. you would need to make certain changes in your factory, certain preparation would need to be made in order to install that machinery. Now that site preparation cost would be included in the cost of the machine. Second, delivery cost, the transportation cost that was incurred from bringing the asset to the factory, that would be included. Any basic installation costs that were incurred to install that machine at the factory, that would be included. And borrowing costs, there's a separate standard over it, as also mentioned here, IS 23, so that I'll be expanding on that later on. Next, expenses such as fuel, training, warranty cost should be written off. This is important. These costs are not to be included in IAS 16 in the cost of the asset. These costs are to be written off, means that these should be expensed in the profit and loss statement. These are not to be capitalized. Alright, those costs include fuel, training, and warranty costs. Next, dismantling cost. This is important. Present value of these costs should be capitalized with an equivalent liability set up. The discount on this liability should then be unwound over the period until the dismantling costs are paid. This means that the liability increases by the interest rate each year, with the increase taken to interest expenses in the statement of profit and loss. Now, what does this mean? So, dismantling costs, that is basically the cost that would be paid at the end of, when the asset has been totally used, towards the end, or towards the when the time when that is being settled, when you pay the dismantling cost, you need to find the present value of the dismantling cost. Let's suppose in 10 years the dismantling cost would be incurred. Now you need to find what is the cost of that in today's date. Suppose, to give a basic example, suppose $1,000 would be incurred as dismantling cost towards the end. You need to find out what would be the cost of that $1,000 in today's date. That would be the present value. Then a liability would be set up of that present value. Next, you need to charge interest on that present value every year. That interest would be expensed to profit and loss, and that interest would be added to the liability. All right. So to simplify it, so first you need to calculate present value of dismantling cost. All right. Second, set up a liability of the present value. All right. Third, this present value is recognized as cost of the asset, as part of the cost of the asset. Next, you have to discount the liability, then be unwound over the period of the dismantling costs are paid. Now let's say, in my example, $1,000 of dismantling costs are being paid at the end of 5 years. You need to calculate first the present value of the dismantling cost. That is, you have to unwind that 5,000 backwards to find its today's value. Then you need to set up a liability of that. The present value that you calculated, that will be included in the cost of the asset. Then you had unwound. Now you have to unwound that discount every year until 5 years. So that basically means that you have to charge interest on the present value every year. All right, until dismantling costs are paid. And then that interest cost would be added to the liability as well. Okay, so this is the process. This is the process. Now, you may need to use the interest rate given and apply the discounting fraction where R is the interest rate and N is the number of years to settlement. So, the discounting factor that is used to calculate the present value, this is its formula: 1 upon 1 plus R to the power of N. Okay, so the formula of present value is, I'll just note it here: dismantling costs multiplied by discounting factor. All right, now this is a example. If an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset, and the present value of the cost of dismantling. If the cost of 10 million to construct and would cost 4 million to remove in 10 years, then the present value of the dismantling cost must be calculated. Now, what does this say? That cost to construct is 10 million. Okay, cost to construct is 10 million. Next is the dismantling cost would be 4 million in 20 years. In 20 years, it would be 4 million, but we need to find its today's value. So you have to calculate the present value of the 4 million. So present value would be 4 million multiplied by the discounting factor. And the formula of discounting factor is mentioned above, which is 1 upon 1 plus R, which is the interest rate of 5%, to the power of N, which is 20 years. Okay, now this would give the value of 1507558. All right, so the cost of the asset, total cost of asset would be 10 million plus 1507558, which would equal to 11,507,558. All right, now we have calculated the present value of the dismantling cost. You would set up a liability of present value which would amount to around 1.5 million. Second, you would have to charge interest on it, or basically unwound the discounting factor. So interest would be present value multiplied by 5%. All right, which is 75,378. Okay, this would be expensed in P&L. And then next, the liability would be increased. So liability at year end would be this present value plus interest. All right, so this would make it 1582936. So This is how this question is solved. So first we saw that the cost is 10 million to construct. All right. Then we need to calculate the present value of the dismantling cost. So first, present value of dismantling cost formula is dismantling cost multiplied by the discounting factor. Dismantling costs are 4 million. Discounting factor is 1 upon 1 plus r to the power of n. R is interest rate, n is number of years until settlement. That gave us around 1.5 million. Now the total cost of the asset would be 10 million to construct plus present value of dismantling cost. Now this present value of dismantling cost, you have to set up a liability for that. You have to charge interest and add that interest to the liability and also expense that interest in profit and loss. So interest calculated is present value of the dismantling multiplied by the interest rate. This would be expensed in P&L and the liability would be added or it would be increased by that interest value. Okay. Now let's move ahead. Okay. Next is subsequent expenditure. Now what we studied right now was initial measurement. Or to give a quick recap of whatever we have studied so far. Firstly, we studied that IA 16. We have studied that IA 16 property, plant and equipment. So this would include tangible non-current assets and it should be for business use. This is the definition. Second, how would you recognize the asset? What is the criteria for recognizing? It is that you have to reliably be able to measure the cost. Okay, reliably measure the cost and you should have some future economic benefit. I'm writing it roughly, not exact terminologies. Second, what would be included in the cost of the asset? Now the cost includes any cost to bring the asset in working condition plus any initial capital costs like transportation, site preparation, and third, present value of dismantling costs. Now, dismantling cost itself is a slightly lengthy topic. So first you calculate present value of dismantling costs and include it in the cost of the asset. Second, you have to set up a liability of the present value. Third, charge interest on that present value. Okay. Fourth, present value in P&L. And fourth, increase the liability by the interest charged. All right. And the formula for calculating present value of dismantling costs is dismantling costs multiplied by discounting factor. The formula for discounting factor is 1 upon 1 plus r to the power of n. This is what we have studied so far. Now, the next topic is subsequent expenditure. So what we studied above was the initial measurement. That is the first time when you're recording the asset in the books. But when you start using the asset, there would be further expenses that would be incurred. Now subsequent expenditure. Now all the expenditure that you incurred after you've put the asset to use, not all of them would be capitalized. Some of them would be expensed to P&L and some of them would be capitalized. Now, what is the criteria for it to be capitalized? The main simple in simple words, the criteria is that any cost that was incurred subsequently, it should increase the productivity of the asset or it should enhance the asset in some way. Now, that enhancement can be in the form of increase in useful life of the asset, or maybe you're expanding the asset. All right, it should basically enhance the productivity of the asset or the efficiency, and the asset should not be in the same condition or in the same productivity level as it was before incurring the expenditure. Now, let's read it. Should only be a subsequent expenditure on property, plant, and equipment should only be treated as part of the cost of the asset if it enhances the economic benefits provided by the asset. This could be extending the asset's life and expansion or increasing the productivity of the asset. All right. As I mentioned, it should enhance the asset. It should provide more economic benefits. It relates to an overall or required major inspection of the asset. So this includes costs associated with this should be capitalized and depreciated over the time until the next overall safety inspection. So first point I've already explained that it should enhance the productivity of the asset. You should get more economic benefits from the asset. Now, if the useful life is increasing, obviously you would be able to use the asset more and get more benefits. So that is a form of enhancement. Or if you're expanding or increasing the productivity of the asset. Now, for example, if you have a 2 BHK house and you're making space to incorporate another room, that would be enhancing the asset, because then you would be, for example, if that is put on rent and you would be getting extra rent from it, so that is an example of enhancement of the asset. So in such case, that cost of building up the third room would be included in the cost of the asset. That is, that cost is qualified to be capitalized. What would not be capitalized is if you're incurring certain repair expenses. Now, repair, it is a required expense, but that is required so that the asset can continue to function at its current productivity level. It will not enhance the asset in any way. That is a bare minimum expense required to maintain the asset's current productivity. Second is, it relates to an overall or required major inspection of the asset. Now, there are certain assets like aircraft and ships which require inspections regularly so that they can continue to function. Now, that is something that can be capitalized, because without that the asset would not be able to function itself. So that is something which is qualified to be capitalized. Third, third criteria is that it is replacing a component of an asset made up of a number of components. For example, an aircraft comprising body, engines, interior, all with different expected lives. The replaced component will be derecognized. So, for example, in the aircraft, if you're replacing the or if you're replacing the engine, for example, now the engine which you are replacing, that is the old engine which is already there in the aircraft, the cost of that you have to derecognize from the cost of the aircraft, and then the new engine which you will be installing, that cost can then be recognized. So if you are replacing a component of an asset, first derecognize the component that you are removing it, and then recognize the component that you're installing in the asset, right? So so a subsequent expenditure can be capitalized if it is enhancing the economic benefits or maintain, or in short, it is increasing the asset's productivity. Second, it is an overall or a safety inspection cost. And third, it is a replacement of component. All other subsequent expenditure should be recognized in statement of profit or loss, because it mainly maintains economic benefits originally expected. So as I mentioned, any cost of general repairs. Now that would be expense in P&L because it is not providing any additional value. That repair would just make sure the asset is working in its current condition smoothly. It would not necessarily enhance the asset. An example, a piece of machinery has an annual service costing of 10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of product per hour. The cost of replacement part is 20,000. Now, see, there are two costs. First cost, it is an annual service cost. This is something which would be incurred every year, and service cost is required so that the machine can function smoothly. It is not enhancing the asset. So which means that 10,000 would be expense to profit and loss. However, the cost of 20,000, if that part is replaced, then the asset will work faster and it will produce more units. So this is increasing the productivity of the assets. So which means that 20,000 can be capitalized. Now, depreciation, pretty easy topic because all of us have studied this. So it is a systematic allocation of depreciable amount of an asset over its useful life. This is the definition. As we all know, depreciation methods are straight line, reducing balance, or what we call as written down value, and then machine hours. Now, if you want to change the method of depreciation, like for example, you have originally started with straight line, but then if you want to move to reducing balance, that change would be an accounting estimate, okay, and it is not an accounting policy. Now, carrying amount should be written off over the remaining useful life, commencing with the period in which the change is made. This would be better understood with this illustration. An asset costs 100,000 and an expected useful life of 10 years. The purchaser intends to use the asset for 6 years, at which point the expected residual value will be 40,000. What is the depreciable amount? This is a pretty straightforward question. Depreciable amount is simply cost minus the residual value, which is $60,000. Alright? Oh, there's one more point here. If an asset is made up of a number of components, each separate part of the asset should be depreciated over its useful life. Now, for example, if the aircraft it's made up of its body, its engine, the seats in the aircraft, all of these are components of the aircraft, and each one of them would have a different useful life. So, you have to keep on depreciating the component based on its own individual useful life. Okay. Review of useful life and residual values. Useful life and residual value should be reviewed at the end of each reporting period and revised if expectations are significantly different from previous estimates. Now, useful life and residual value, these can change as and when you use the asset. You may not end up using for example, if the useful life is 10 years, but certain major malfunction happened within 4 years, then obviously the useful life would reduce. It may not continue to function until 10 years. So in that case, you have to ensure that you are updating the useful life and residual value timely. The carrying amount of the asset at the date of revision, less any residual value, should be depreciated over the revised remaining useful life. So, the date when you make the change in the useful life or the residual value, you have to calculate the carrying amount at that date of change and then depreciate the asset over the remaining useful life years. A question would be better to understand that. Now, uh, an entity purchased an asset for 20,000 on 1st Jan 20x3. Straight line depreciation of 5,000 per annum has been charged, assuming a 4-year useful life with no residual value. On 1st Jan 20x5, the annual review of asset lives was undertaken, and the remaining useful life of this asset was estimated 4 years. The financial statements for the year ended 31st December 20x5 are being prepared. What is the depreciation charge for the year ended 31st December 20x5? Now, so on Jan 1 20x3, you purchased the asset and its cost was 20,000. You are charging depreciation of 5 years and the useful life is 4 years. Alright. On 1st Jan 20x5, you have reviewed that the useful life uh, annual review and the remaining useful life of the asset was estimated at 4 years. Okay. Now, on 1st Jan 20x3, the cost is 20,000. On Jan 1 20x5, the carrying amount would be the initial cost minus depreciation. Depreciation is 5,000 per year. And from 20x to 20x5, it's 2 years. So that means it would be 10,000 depreciation. That would give you the value of 10,000 on Jan 1 20x5. Now the remaining useful life is 4 years. So the remaining useful life is 4 years, and the question asks what is the depreciation at the year end 31st December 20x5. So in Jan 1, the cost is 10,000, useful life is 4 years. So depreciation formula is simply carrying amount divided by the useful life, which is simply 10,000 divided by 4. This would give you 2,500. Okay. So we just calculated that on the date when the uh, change was made. So we calculated that on Jan 1 it was 20,000. On 1st Jan 20x5 it was 10,000 the value. And then we found out that the remaining useful life was 4 years. So we did 10,000 divided by 4 to get depreciation as on 31st December 20x5. Depreciation value is 2,500. Okay. Next, inspection and overall costs are generally expensed as they are incurred. They, however, capitalize a non-current asset to the extent that they satisfy IAS 16 rules for separate components. This is the same point which was discussed in subsequent expenditure topic, that any inspection overall costs are to be capitalized if they are qualifying the criteria. This is pretty self-explanatory illustration. Now, good. Next topic is revaluation of non-current assets. So as we had studied that there were two methods of recording assets under IAS 16. One was through cost model and second is through revaluation model. So we studied cost model above. Now for revaluation model, IAS 16 allows a choice of accounting treatment between the cost model and revaluation model. Cost model is simply should property, plant and equipment should be valued at cost less accumulated depreciation. Pretty straightforward. Whereas in revaluation model, property, plant and equipment may be carried at a revalued amount less any subsequent accumulated depreciation. If the revaluation alternative is adopted, two conditions must be complied with. Okay, so it says that if you want to value using revaluation, then there are two conditions. First, revaluations must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. Okay. And second is that when an item of property, plant and equipment is revalued, the entire class of assets to which the item belongs must be revalued. Now, this means that if you are adopting revaluation model, that is basically you are valuing the asset time and again based on the fair value. So you should do it with sufficient regularity to ensure that the carrying amount of the asset should not differ from the fair value. Okay, there should be sufficient regularity with which revaluation should be done. And second point is that if you're valuing certain asset at using revaluation model, then the entire class of that asset must also be revalued. You cannot just choose a single asset from the entire class. Then the entire class must be revalued. Okay. Now, how do we account for revaluation? Steps are: restates the asset cost to the new valuation, eliminate any existing accumulated depreciation, show the total increase in OCI at the foot of the statement of profit and loss. This would be taken to the revaluation surplus, much like the profit for the year gets taken to retained earnings. So, if I have to simplify this, suppose you are valuing a machinery using revaluation model. Let's say right now the carrying amount is $10,000. You're revaluing after 1 year, and the fair value after 1 year during that day, it is, let's say, $15,000. Now, right now the value is 10,000. First, you need to find the carrying amount of that machinery at the end of next year. So let's say right now it is 10,000 in today's date. Next year, the carrying amount, let's say it would reduce from 10,000 to, let's say, 9,000 due to charge of depreciation. So next year, when you're revaluing it on the date of revaluation, the carrying amount is 9,000. The revaluation amount is 15,000. So the difference of 6,000 would be revaluation gain. Okay, so the difference is revaluation gain. So first you need to find out what is the carrying amount of the asset at the revaluation date. Find the difference between revaluation amount and carrying amount. That would either be a gain or a loss. Okay, and that gain or loss would be further accounted for in OCI. Now, there are further steps for it. There's a little detail on revaluation gain and loss which will be studied now. But the journal entry is that non-current assets is debited, revalued amount minus cost. Accumulated depreciation is debited, and OCI is credited, which is the revaluation surplus. Okay. Now, okay, let me write a note. So we are following revaluation model. Okay. First, find the carrying amount on revaluation date. Okay. Second, difference between revaluation or revalued amount and carrying amount. Third, now that difference would either be a gain or a loss. Okay. Now, let's say if it's a gain, it would go in other comprehensive income. Let's say if it's a loss. If it's a loss of, let's say, for example, if it's a loss of $5,000, if it's a loss of $5,000, but there is already a revaluation gain in OCI for the same asset or for the same class of asset of, let's say, $7,000, then you have to record the difference. That is 7,000 gain was already there for the same asset, and you incurred a loss of 5,000 on revaluation. That means the net amount to be recorded in OCI would be just 2,000. Okay, so this is important. This is important. All right, and then when you revalue the asset from that date, the new revalued amount becomes the carrying amount. All right, on the date of revaluation, that new revalued amount becomes the carrying amount, and then from there you charge depreciation normally. Now let's read through it as well. See, revaluation gains are recorded as component of other comprehensive income, either within statement of profit and loss and OCI or in a separate statement. This gain is then carried in a revaluation surplus within equity. Okay, so this revaluation gain is also recorded in equity. The revaluation surplus is a capital reserve and it cannot be distributed to shareholders. Revaluation losses, which represent an impairment of the asset value, are recognized in the statement of profit and loss. Okay, when a revaluation loss arises on a previously revalued asset, it should be deducted first against the previous revaluation gain and can therefore be taken to other comprehensive income in the year. Any excess impairment will then be recorded as an impairment expense in the statement of profit and loss. In short, if I simplify this, let's say in example 1, there is revaluation gain of $5,000. Simple revaluation gain. You will record this in OCI, other comprehensive income. In example 2, there is revaluation loss of $5,000, but there is revaluation gain already in OCI for the same asset of 7,000. Then in OCI, you would record 7,000 minus 5,000 equals 2,000. In example 3, there is revaluation loss of 5,000, but there is no revaluation gain in OCI. Then in that case, the 5,000 loss of revaluation loss will be expensed in profit and loss. Okay, this is basically impairment. This expense is known as impairment because impairment, there's a separate standard on that, but it's basically when the carrying amount is less than the fair value. That is impairment. Okay, so there are three possibilities. If it is simple revaluation gain, just add it in OCI. If it is a revaluation loss, but if there is a revaluation gain for the same asset, then you have to only record the net value in OCI. And third case, there is a revaluation loss, but you don't have any gain in OCI available. Then in that case, you have to expense an entire loss in P&L. Okay. Now, this is a question. An entity revalues its building and decides to incorporate the revaluation into financial statements. So, extract from statement of financial position 31st December 20x7 is buildings, the cost is 1200, depreciation is 14144. So, this is the carrying amount 1056. The building is revalued at 1st Jan 20x8, which is basically the next date, at 1400,000. Its useful life is 40 years to be at that date. Show the extracts of financial statement 31st December 20x8. Now, the date of revaluation is 1st Jan 20x8. Date of revaluation is 1st Jan 20x8. Let's find the carrying amount of the asset at that date. Okay. So 31st December 20x7 first, and so carrying at 31st December 20x7, they've already given that the carrying amount at that date, or let's say carrying amount at 1st Jan is 1056. Okay. The revalued amount is 1400. So that means the revalued amount is 1400. Carrying amount was 1056, which means it is a revaluation gain. Revaluation gain of 344. Okay. Revaluation gain is of 344. Now the new carrying amount, basically now the new carrying amount is 1400. Now the depreciation would be on this new carrying amount, which is 1400 divided by the useful life of 40 years. The useful life is 40 years from that date. So the depreciation would be 35. Okay. Now this is new carrying amount on Jan 1. And carrying amount at 31st December would be the carrying amount at the start of the year minus depreciation for the year, which would give you 1365. Alright. So in statement of profit and loss and P&L, you would charge DEP of 35. You would charge OCI gain of 344. And in SOFP, the value of PPE or non-current asset would be 1365. And in equity, because revaluation gain is also recorded in equity, revaluation gain would be 344. Okay, this is the simple question. Now, depreciation on revalued assets. Once an asset has been revalued, the following treatment is required. Depreciation must be charged based on valuation less residual value. That is pretty much the new carrying amount. See, when you revalue the asset, that becomes the new carrying amount. That is, 1400 was revalued. Now 1400 become the carrying amount, and from here you have to start depreciating it from 1400. Okay. The whole charge must go to statement of profit and loss from the year. An annual reserves transfer may be made from revaluation surplus to retained earning for the additional depreciation charged on the revalued amount compared to cost. This permitted treatment under IAS 16 is to address the imbalance between non-distributable gain held in revaluation surplus and the reduction in retained earnings. So pretty much after you revalue, like for example, before the value was just 1056, and so before the depreciation in this case was 144, and after revaluation, this is accumulated depreciation. And after revaluation, it, so let's say before the depreciation, so basically they're saying that once you revalue the asset, let's say if it was an increase in the valuation, the excess depreciation that has been charged and the depreciation that was charged before revaluation, the difference of that can be taken from retained earnings. So an annual reserve transfer may be made from revaluation surplus to retained earnings. Okay, that difference between the depreciation after revaluation and the depreciation before revaluation can be, a reserve can be made for it from the revaluation surplus in OCI to retained earnings. So a transfer can be made from revaluation surplus in OCI to the retained earnings for the difference in depreciation after revaluation and before revaluation. But this is optional, it may be made. Now, the journals would be that debit depreciation, credit accumulated depreciation, and debit revaluation surplus, that is depreciation on valuation minus depreciation on original cost. Credit retained earnings. This transfer is not part of OCI, it is shown in SOCIE only. Solve this example. So on 1st April, the fair value of XU's property was $100,000 with a remaining life of 20 years. Okay. XU's policy is to revalue its property at each year end. At 31st March 20X9, the property was valued at 86,000. The balance of the on the revaluation surplus at 1st April 20X8 was 20,000, which relates entirely to property. XU does not make a transfer to realized profit in respect of excess depreciation. Now, the date of revaluation is 31st March 20X9. The carrying amount before revaluation on 31st March would be $100,000 was at April 1st. Now the carrying amount is basically cost minus depreciation. So at 31st March, the carrying amount would have been 100,000 minus depreciation, which is 100,000 divided by 20, which is 5,000. So 100,000 minus 5,000, which is 95,000. The revalued amount is 86,000. Now, the carrying amount was 95,000. Revalued amount is 86,000. So this is an undervaluation, which would mean it's a revaluation loss of 95,000 minus 86,000, which would be 9,000. 9,000 is a revaluation loss, but there is already a revaluation surplus of 20,000. So the net revaluation surplus would be 20,000 minus 9,000, which would be 11,000. All right. So basically, the non-current asset would be, we have reevaluated to 86,000. So non-current assets, the value of non-current assets would now be 86,000. In statement of profit and loss, the DEP would be 5,000, because for the year we charge the depreciation of 5,000 is calculated here, and the revaluation loss is 9,000. All right. Now, in equity, that is the OCI that you would record, you would just record the net amount, which is 11,000. All right. So this is what would be recorded. Now, disposal of revalued non-current assets. The profit or loss on disposal of revalued non-current assets should be calculated as a difference between net sale proceeds and the carrying amount. Okay. So there are two steps. It should be accounted for in statement of profit and loss in the period which disposal occurs, and any balance on revaluation should now be transferred to retained earnings. Now, uh, let's solve an example itself. Derek purchased a property costing 75,000 on 1st Jan 20x4 with useful life of 10 years. It has no residual value. At 31st December 20x4, the property was valued at 810,000, resulting in a gain of revaluation being recorded in OCI of 135,000. There was no change to its useful life. Direct does not make a transfer of realized profit in respect of excess depreciation on revalued assets. On 31st December 2006, the property was sold for 900,000. How should the disposal of the previously revalued asset be treated in financial statements for the year ended 31st December 20x6? Now, the property is being sold. What is the date of disposal? Date of disposal is 31st December 20x6. Okay, let's calculate what is the carrying amount at that date. Carrying amount at that date or disposal date. So on 1st Jan it was 750, but it was revalued at December at 810. So it was revalued at 810, and the useful life, so it has useful life of 10 years. After revaluation, they have told that there was no change to useful life. So from 1st Jan to 31st December, 1 year has already passed. So means that now the useful life is of 9 years. So we are calculating what is the carrying amount at 31st December 20x6. We know that the carrying amount at 31st December 20x4 was 810,000. Let me write like this. Carrying amount at 31st December 20x4 was 810,000. Depreciation for 2 years, because we are at 20x4 and we have to find out carrying amount at 20x6. So depreciation for 2 years would be 810 divided by 9 years, because from 1st Jan to 31st December 20x4 already 1 year has passed. So from 31st December 20x4 to 31st December 20x5 to 31st December 20x6, we have to find for 2 years. Already 1 year had passed. So remaining useful life was for 9 years. Now divided by 9, we would get 1 year's depreciation, but we have to find that for 2 years. So this would be 180. So carrying amount at 31st December 20x6 would be 810 minus, sorry, this is not 810, this is 900. Property was valued for 8, oh no, this is 810. Would be 810 minus 180. This would be 630. Okay. So we know that the carrying amount at 31st December 20x6 is 630, and we know that it is being sold for 900. So the value was 630. It is sold for 900. So that means gain on sale is 900 minus 630, which is 270. Now this gain, it would be recorded in profit and loss as income on the income side. And so this was the first condition, that the gain, it should be recorded in profit and loss, and second is that any balance or revaluation surplus should now be transferred to retained earnings. So if they have told that the balance or revaluation surplus was 810, now 810 would be transferred to retained earnings. Okay, so it will be debit revaluation surplus and credit retained earnings. Okay. So first step, we found out what is the carrying amount at 31st December 20x6 or the disposal date. To find that, we found that we calculated the depreciation for 2 years. because we already know that on 31st December 20x4 the value was 810. We calculated depreciation for 2 years, which came to 180, found the difference and got the value as 630. The sale value was 9,000, the carrying amount was 630, so it was a gain of 270, which would be recorded in P&L. And then this was the first point, and second point is that any balance on revaluation surplus is transferred to retained earnings on disposal. So 810 would be transferred to retained earnings. So debit revaluation surplus, credit retained earnings.